So just starting on the market outlook, first of all, from a very long-term perspective, uh, how much to allocate in equity is obviously a very important question. Uh, the way we think the best way to look at equities over the long term is what is the return above inflation, what we call a real return, because this, when you see on 10, 20-year basis, keeps converging back to about 6 to 7%. And this is not true of India only. Uh, Almost every stock market in the world, this seems to hold that a very long-term returns converge to 6 to 7% above inflation. So if you see our 10-year return is slightly above average, today about 8% versus let's say 6.5% is the average. 20-year return is more in line with the average, around 6.5%. So net, the inference here is basically that equities is very close to being fairly valued. There is no reason for investors to be very defensive or very aggressive. Now the question is, should we wait for a distress valuation to happen or not? Generally, we think that asset allocation today should not be very defensive, and I'll come to that in a bit. But essentially, if you see this chart, it definitely seems to suggest that we are very close to being uh, almost perfectly at fair value or something. Now, what are the important trends we are seeing in the global and domestic economy, and what are the sectors we like? So I'll just talk a bit about what are the important trends. First of all, in spite of all this noise of tariffs and wars and geopolitical issues and Trump tantrums, essentially, if you see, the global economy is actually doing very well. Uh, there are multiple indicators for this. So OECD, which is basically a set of developed countries, they have a leading indicator. You can see that that has been going up over the last few months. Um, City also has an economic surprise index, which is essentially this high frequency data, PMI, ISM, uh, railway data, port data, whatever. How much is it surprising on the positive side or negative side? Uh, a positive number is basically means that the economy is doing better than expected. And as you can see, the economic global surprise index is quite healthy. Essentially, means global economy is doing much better than expected. Um, Other way to look at it is typically when economy is doing well, the industrial metals, which is basically aluminum, copper, zinc, steel, their prices tend to be healthy. And that also we are seeing that over the past 6 months, all these industrial raw material prices have gone up. Uh, Also, the bond yield curve, which again is a sign of inflation and growth. If you see the spread between 10-year yields and 2-year yields, whether it's US or any other major economy, Europe, UK, Japan, India, the spread of 10-year minus 2-year has gone up, which typically means that the bond market is expecting growth and inflation to be healthy over the medium term. Um, and finally, when you see the currency market, uh, generally in a good economic environment, the dollar weakens and emerging market currencies strengthen. And if I take the yuan as a good representative of emerging market currency, we have seen that yuan, after reaching a bottom of 7.2, 7.3, now is less than 6.9. So there's been 3-4% appreciation in yuan, which typically means one is that Chinese economy is probably doing better than expected, and two is, of course, as I said, that the dollar is weakening and emerging market currencies are attracting inflows. So these multiple indicators suggest that we are in a inflationary acceleration of the global economy. Typically, this is obviously good for cyclicals, and also see the India business cycle is dependent on the global business cycle. So if the global business cycle is doing well, generally it will mean that the India business cycles, for example, the private sector capex, there is a big correlation between global private sector capex and India private sector capex. Hopefully, with some lag, uh, if this strength in global economy is there, Indian economy should also accelerate. Second is on the liquidity, which is going back to the point that markets being at fair value from a long-term perspective, should we wait for distress valuation? See, I think distress valuations are a bit difficult to get in this environment, basically because government debt is very high. Now, why this is important is, first of all, this is quite unprecedented level of government debt. Most countries today are more than 100% debt to GDP. Why it is important is when governments have so much debt, they basically print money. That is, they essentially will keep interest rates low. The central bank will buy bonds, etc. Because if government has to bear the interest burden, being a big borrower, it is in the interest of the government to keep interest costs low and to keep liquidity high so that there is reasonable nominal GDP growth. Um, See, if you see Japan, which has the most extreme ratios on government debt to GDP, over last 20 years, basically the interest rate in Japan has been less than inflation. So the real interest rate, what we call, has been negative. With the result that there's been a lot of money printing in Japan to keep these interest rates low. The central bank has bought more than 40% of the government bonds. Um, and the result is basically that equities has outperformed cash or debt, and the currency has lost value against gold. Um, we think that is likely to occur in rest of the big economies like US, Europe, UK, etc. Which is why we think that while markets are not cheap, it may make sense to have healthy allocation to equities. Um, Essentially, when you see what can the government do to reduce debt to GDP, most of the long-term things they can do are very difficult to do politically, which is basically increase real GDP by a lot of structural reform, reduce government expenses, increase taxes. All these are obviously very difficult to do politically, which is why we think that globally liquidity will be healthy as governments will reduce interest rate and increase the amount of money in the system by central banks buying bonds, etc. That is good for all risk assets, which is why also from an asset allocation viewpoint, I think it's good to have a diversified set of all risk assets, whether it's gold, silver, emerging market equities, Indian equities, US equities. Obviously, based on valuation, we can be a bit nimble and keep changing. So, so today, generally, we like Indian equities more than gold, silver because gold, silver has done very well. But just for discipline and diversification, it's good to have uh, multiple risk assets in the portfolio, I think. But there has been pressure in the rupee. Now, this pressure is uh, very difficult to predict because, see, if the pressure is from current account, usually that is more uh, natural to understand and see how it will get rectified. Because let's say if a country's imports are much more than exports, At some point, the currency will depreciate, imports will become more expensive, so they will slow down, exports will become more competitive, they will go up, and the current account balances. That's usually how, if there is pressure on current account, that's how currencies behave. Now, India is in a bit of a strange situation where most of the pressure is coming from capital flows, essentially of two types. One is foreigners are selling equities, and also last 4 5 months, Indians have been buying a lot of gold and silver. We've all seen how gold and silver ETFs have attracted money, and gold and silver are essentially imported items. So we have seen current account is relatively stable, but the balance of payment, which is current account plus capital account, has become negative because of the negative impact in the capital account. Now, this pressure on currency, we think, is bottoming out, which is why we think Indian markets should not suffer too much underperformance from here on. We think we're close to the last 15 months. There's been time and price correction in a sense in most stocks, not so much in large caps. Uh, we think we're kind of coming to the end of the cycle, although the IPO supply remains strong. But essentially, if rupee bottoms out, we think there is not too much downside left. So what will mark the bottom of the rupee? Three, four things, and in a way, last couple of months, all are happening at the same time. One is the dollar. If it globally starts correcting, which has also happened a bit over the last 1 month or so. Second is the US India agreement, which has also happened. Uh, Third is basically if there's a lot of momentum in gold and silver prices, which has attracted Indian investors. I think if we don't expect gold silver to correct too much, but if they become stable, where near-term gains are not there, I think that will result in some of this momentum buying of gold silver coming down, which also seems to be happening. And finally, uh, the AI direct plays have been a big theme globally, first in US and then in China, South Korea, etc., which is basically your infrastructure guys like Nvidia, Samsung, Alibaba, Baidu, etc. Um, that theme is not there in India, which is part of the reason why foreigners have been selling India. But thankfully, if you see the momentum of these mega caps in AI, that also seems to have slowed down over the last 2 3 months. It's not crashed, obviously, but the prices are not going up as fast as they used to. So that should also help India get more interest from foreign investors. Other thing that will help is I think near term earning outlook is better. One is that because of base having nominal GDP will pick up with inflation, and obviously corporate earnings are linked to nominal GDP and not real GDP. Second, rupee depreciation helps. And third is global growth is resilient. So a lot of exporters are facing a global environment which is quite healthy. Negative is that the capex push of government is coming down. So some of the smaller sectors like roads, railways, they may face headwind, but their weight is not much. So if you see Nifty earnings, I think next 2 year average growth rate should be around 15% minimum, which is obviously better than last 2 years. And that will also help, I think, attract foreign investors. Having said that, we do think from a medium term perspective, large caps will not exhibit very fast growth. Essentially, last from 2020 to 25, we have seen large cap earnings outperform nominal GDP by a big margin. And in the very long term, they tend to be the same. So next 3-5 years, we don't think Nifty 50 earnings will average more than 11-12%, which is broadly the nominal GDP that is likely. Finally, on domestic flows, see, essentially there are four big asset classes Indians invest in: bank, FD, equities, gold, and real estate. Bank FD is obviously a very defensive asset class. Risk assets typically between real estate, gold, and equities. If you see, real estate also has gone through a upcycle post COVID, and now it is plateauing out. I think house prices in most of the big cities now have reached a level where it is difficult to get too much appreciation in property prices. And if you see gold, that has obviously been the star asset last 2-3 years. Uh, it has reached a level where today India household own more than twice the amount of bank deposits in gold. And with such a sharp increase in prices, as I said, we generally think that once the momentum in gold and silver prices stabilizes, the amount of investment going into gold, silver should also start coming down. So essentially, we do think domestic flows to equities should continue, given that two big competitors, real estate and gold, also are not looking that attractive at this point of time. In terms of risk, three, four things. One is globally, the long bond yields, basically 10-year yields and 30-year yields, they are very high. And they are a kind of competitor for equities because ultimately, if US 30-year yield is 5%, beyond a point, that may attract flows versus US equities. At this point, equities are doing fine, but if let's say the 30-year yields go up another 0.5 to 1%, I think globally equities will be under pressure and that will affect Indian equities as well. The second is when we see credit, uh, there is a lot of complacency there because a lot of credit has moved to the private market instead of banks, etc. globally. Um, if there is some big accident in global credit, I don't think there's any big issue in Indian credit because India credit has not grown that fast on an overall basis. Some pockets here or there may come under stress, but globally, credit has grown in the private credit space a lot. So if that becomes a stress point, then there may, again might be a global correction in equities. On India side, one is that some slowdown may happen because government expenditure is slowing down. Hope is that private sector capex will start picking up and consumption will start picking up. Also, with global economy, export should do okay. Apart from something like IT services, that seems to be disrupted by AI to a certain extent. But overall, export should do okay if global economy is good. Uh, the more structural risk is if AI starts impacting more than just coding into various kinds of jobs. Like India is a big exporter of services with these global captive centers. They do all kinds of work, but mostly white collar work like accounting, consulting, auditing. Now, if all of these segments start getting hit by AI very fast, then we may see current account of India become a pain point, which will obviously lead to growth slowdown, net pressure on currency. Our take is it's too early to conclude. Usually, new technologies have created jobs at a net level, although the kind of jobs has changed. But once one segment of jobs is destroyed, but another segment of jobs comes up. Hopefully, the same should happen with AI. But yeah, we have to keep our minds open because this is a very different type of technology versus what has happened historically. So net, just to summarize, near-term outlook over last 1 month has become positive relatively. Absolute downside looks limited, but again, we don't expect market to run away given that the IPO supply is very, very high. Maybe after one or two big IPOs struggle, that may be the bottom of the market. A lot of things have improved at the margin. Valuations in absolute level, valuation relative to emerging markets and gold, what we talked about. And finally, from a market cap perspective, we feel, in fact, that small caps may actually outperform 3 to 5 years selectively. So, good small cap fund we feel has the potential to outperform large and mid cap indices because not all small caps are obviously not all small caps are very cheap right now. But given the vast universe and the kind of time and price correction in a lot of small cap, I think if the stock selection is right, we can get a set of small caps which may materially outperform large and mid cap. That's a view on market cap. Let me just spend couple of minutes on what we like in terms of sectors or themes. One is, I think, from a valuation versus growth perspective, large banks seem quite attractive, may not give very high return, but as steady compounders, we like relatively actually the more cheaper banks, whether it's PSU banks or some of the private banks, because most of these banks are cheap because of some asset quality issue which has happened in the past. We generally think that asset quality will be pretty fine. Household balance sheet has improved with appreciation in gold prices. The corporate capex seems fairly robust in terms of safety because globally growth is fine. Um, and there's not been too much of fast lending or growth in lending over the last 2 3 years. We've had credit growth roughly in the 9-10% range. Usually, big asset quality problems come when there is very rapid expansion in credit growth. That obviously has not happened. So we like financials. We like insurance also because it has good growth without valuations being very high. So both general and life insurance we like. Um, we like some of the manufacturing exporters, whether it's in capital goods or auto ags, etc. Because global economy being relatively good, plus the fact that this recent depreciation rupee has been um, kind of unique in the sense that most of the other big manufacturing linked currencies like euro or yuan, they have actually appreciated against the dollar while rupee has depreciated. So in a way, manufacturing has got a good competitive advantage with this trajectory of currencies where euro and yuan have appreciated, whereas rupee has depreciated against the dollar. So we do think that there is option value that the yuan in particular may appreciate a significant amount from here because globally there is pressure on China to rebalance. They are the country with the biggest current account surplus. So if they have to rebalance the economy, then they have to let the yuan appreciate. So we like some of the manufacturing export sectors. Um, we also like some of the internet platforms which have corrected recently because ultimately A lot of them are going to be in dominant positions over the long term. At this point, obviously, some competition may be there and margins may be weak. But usually, these sectors consolidate, and the weaker guys who are making losses go out. So we like some internet platforms as well. So yeah, I think these are few themes we like.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.